All right, today we're going to talk about DoorDash. And it's this really fascinating story, right? A company that was just on fire, this high-growth darling that seemed unstoppable until, well, it hit a brick wall. So we're going to dig into this paradox. How could its biggest strength, that insane growth, also be the thing that brought it to its knees?
Okay, let's just start with one number. That's all you need to know to get the picture. Negative 17.5%. That's how much DoorDash's stock just plummeted in a single day. This was right after their Q3 earnings report, and it was just this brutal, shocking drop that had everybody on Wall Street scrambling.
So you gotta ask, right? How does a company like that, a Wall Street darling with these incredible growth numbers, a story that investors just loved, how does it suddenly lose almost a fifth of its value? That's what we're gonna unpack. We're looking at this huge clash between the amazing story they were telling and the cold, hard numbers behind the scenes.
But look, to really get why the fall was so dramatic, you have to understand the rise. And what a rise it was. For years, DoorDash wasn't just a company, it was the growth story. Wall Street was absolutely captivated.
I mean, right from its founding back in 2013, this thing was a rocket ship. After their huge IPO in 2020, they just went on this massive shopping spree, snapping up companies left and right, expanding overseas, beefing up their tech. They were transforming from just a simple delivery app into this huge, sprawling empire for local commerce.
And just look at the scale of this growth. It's wild. In just one quarter, we're talking a 20% jump in gross order value. That's the total value of everything ordered on the platform. It came out to over $23 billion. That's billion with a B. And that came from 732 million separate orders. So yeah, this wasn't some little startup anymore. This was a full-blown juggernaut.
And you really have to get this. Investors weren't just buying a food delivery service. No way. They were buying into this huge vision, this idea about the future of how we shop locally. They saw this platform that was only going to get stickier and more powerful as more people joined. And then, when the company announced a massive $5 billion share buyback, man, that was like the ultimate signal of confidence. Investors bought that story hook, line, and sinker.
But underneath all that shiny, exciting growth, some pretty expensive cracks were starting to show.
And this is where the big question started to creep in. It's the one that started getting whispered around the market. All this growth is great, right? Millions of new orders, fantastic. But what did it actually cost to get each and every one of those orders? Was this profitable growth, or was it just really, really expensive growth?
And this right here, this gets to the absolute heart of the problem. You had two completely different stories going on. The public story was all about high revenue, this massive market, the future of commerce. But the private reality? That was a business that was just bleeding cash on operations and fighting tooth and nail against some serious competition.
Okay, to really get this, we gotta talk about something called unit economics. Now, it sounds super technical, I know, but the question is actually dead simple. For every single delivery that goes out the door, is DoorDash making money, or is it losing a little bit of money? That one question is at the absolute core of this whole thing.
So the crazy thing is, these risks weren't some big secret. I mean, everybody knew the delivery model costs a ton of money. They knew that new areas like groceries had these paper-thin margins. But for the longest time, the market was just happy to look the other way. They were completely mesmerized by those incredible top-line growth numbers.
And that brings us to the tipping point, the moment of truth. The day the market just couldn't ignore those cracks anymore, and the whole story, the whole narrative around DoorDash just completely flipped.
All right, so it's early November 2025. DoorDash drops its third quarter results. And look, the headline numbers, the growth, it all still looked pretty good. But what they said along with those numbers, well, it was a brutal 1-2 punch for investors.
So punch number one, they missed on profit. Wall Street was expecting something like 68 cents a share in earnings. DoorDash delivered just 55. And that was the first really hard piece of evidence that, whoa, wait a minute, this company isn't turning all that amazing revenue into actual profit like we all thought they were.
Then came punch number two. And honestly, this one was probably even bigger. The CEO, Tony Xu, comes out with this quote, and he basically tells investors, hey, brace yourselves. He announced they were planning to spend hundreds of millions more next year. The message couldn't have been clear. If you're waiting for profits, you're going to be waiting a while.
And if that wasn't enough, here's the knockout blow. Their forecast for the next quarter was weaker than expected. They gave guidance on a number called adjusted EBITDA. It's basically just a way to measure core profit. And that forecast confirmed every investor's worst fear. It showed that rising costs and all this new spending were going to absolutely crush profitability for a while.
When you look at the numbers, the reality of the business is just stark. Think about it like this. For every single dollar DoorDash made in revenue that quarter, more than 92 cents went right back out the door just to cover costs. That leaves you with almost nothing, a razor-thin margin for any kind of error.
And the market's reaction? It was fast and it was brutal. Literally overnight, the whole conversation changed. Nobody was talking about order growth anymore. The only question, the only thing anyone wanted to know was, when is this company actually going to make money?
So, okay. What's the takeaway here? What do we learn from all this? Well, if you're an investor, especially someone looking at these high-growth tech companies, the DoorDash story is basically a masterclass in what to look for and, maybe more importantly, what to watch out for.
It kind of gives us a simple checklist, right? A playbook for any growth stock. Step 1, don't just look at the revenue growth. You got to ask, is it profitable growth? Step 2, track the margins. Are they getting better over time or are they getting smaller? And step 3, when they announce some huge new spending plan, be skeptical. Ask when that spending is actually going to deliver a return. Because the real story, it's almost never the one in the big headline.
At the end of the day, a great story, a great narrative is incredibly powerful. But it's not enough. It's just not. It has to be backed up by a solid business model, one that can eventually deliver real sustainable profits. Because if there's one thing the DoorDash saga proves, it's that when that narrative finally breaks, man, it can break fast.
And that leaves us with this one big question, right? Growth is exciting. We all want to find and ride that next big wave. But the DoorDash story reminds us that the real challenge isn't just finding the wave. It's figuring out if you're about to ride it on a solid surfboard, or if the whole thing is just a house of cards waiting to collapse.